Hey everybody, welcome to Mortgage Today for Friday, August 4th, 2023, and oh, what a day it was. It's Jobs Day. A shorter work week and lower payroll growth plus a downward revision to last month's payrolls argue a bond-friendly reading on the jobs report. But slightly higher wages and lower unemployment push back the other direction. So we got non-farm payrolls, which came in at 187,000 versus a 200,000 forecast. It was 185 previously, indicates weakness. However, June was revised lower by 24,000 from 209 to 185. May was revised from 306,000 to 281,000, which shows weakness in the economy. But wages came in at 0.4 on a 0.3 forecast. Was 0.4 previously, indicates strength. Part-time workers were a large part of the job gains at plus 972,000, while full-time workers were negative. Actually took away 585,000 jobs, which indicates weakness, but the unemployment rate went down, which indicates strength, and the work week actually went down, which indicates higher productivity and strength. So kind of tug of war in both directions. Bonds initially gained a few basis points on the NFP headline, then the yeah buts started lifting yields. We were up 34 basis points real early. Stocks picked up 23 points in the morning. Then durable goods orders came in at 4.6 on an estimate of 4.7, but factory orders rose by 2.3% from 0.4% though, so another mixed bag. The stock market erased gains as Apple Inc. dropped below the $3 trillion mark, and some other megacaps like Tesla and Meta pushed lower. Bond yields fell as a mixed jobs report did little to alter the bets on the outlook of the Federal Reserve policy. Rates were arguably oversold coming into today's jobs report, but certainly could have continued higher if NFP was much higher than expected. Thankfully, it wasn't. Still great numbers, but not enough to justify defensive posture leading up to them. Bonds spent the rest of the trading session correcting that posture. Some of the correction could have been short covering on a Friday. Some could be a legitimate attempt to get in a more nimble position ahead of next week's CPI data. At the end of the day, MBS were up 69 basis points on the day. Stocks lost about 24 points. Closing out the week, we're at 99.06, which puts us in the middle of this range, which is bordered by the floor of a Fibonacci R1 line at 98.716 and a ceiling at 99.219. So hopefully we can stay above that Fibonacci line. Another data in real estate news, I just saw this, I thought it was interesting, is that the top 1.5% of all real estate agents account for 68% of all sales. The top 2% you're at 75%. So 75% of all homes are sold by the top 2% of agents, and the top 10% of agents sold 90% of the homes last year. Also, interesting chart, years worth of income needed to buy a median home. So if you look at this, back in 1970, the average mortgage rate was 5.05. Median household income shows this. The number of years worth of income needed to buy a house was 2.7. In 2022, it is 7.6 years worth of income needed to buy the average home. That's crazy. Looking at the economic calendar for next week, Monday and Tuesday are fairly light. Wednesday, we get a couple of note auctions with the glut of supply coming. Those should be interesting to see how those play out. And then we get all the hits on Thursday and Friday. So we get core CPI, headline CPI, as well as jobless claims and a bond auction on Thursday. And on Friday, we get the PPI numbers. So it's going to be a big indicator of what the Fed is going to do. We'll come with that data on Thursday and Friday. So definitely get some relaxing in this weekend and hopefully work on some things that you do have under your control, like your brain, particularly checking out our sponsor at thatmakesense.com.